financial reporting, to also cover corporate reporting in terms of performance evaluation of a company, in terms of how to measure a company's performance with the use of relevant financial ratios to measure company's performance. So that's what we'll be looking at today in this question. And this question is very big, and I would like us to um, please try to pay attention so that we can get it once and for all. So like I always do, I would like us to go through the question together so we can understand it before we now look at the solutions together and then um, explain, and we'll just proceed. So now the requirement here is that we should, number one, assess the accounting treatment of the change in accounting policy and state the impact on the return on capital employed, which is the ROCE. That's the A part of it. Then the B part is towards, which is carrying more of the marks. C of Lawani 15 marks. So that's, I mean, for me, this is the one carrying the biggest mark in this question, and that is where more work will be required of us. And then the C part is briefly discuss two limitations of the analysis done in B above. So this is a big question, 20 marks. Yeah. So now I will read through the question and then we'll proceed with the solution. Below is the draft financial statement of Lawani PLC, a manufacturer of fast-moving consumer goods, FMCG. So we have the statement of financial position. We have the non-current asset information, current asset information. We have the equity and liabilities. Let's assume all things are correct here. And then we have the statement of profit or loss, which shows us the position of the company as to whether they're making profit or loss, or their financial stance, and put it that way, right? So we have that there as assume all figures are correct. Then the following additional information are relevant. From figure 1, the company changed its accounting policy from the cost model to the revaluation model for its property, right? The amount in revaluation reserves represents the revaluation surplus recognized in 2017. And then non-adjustment was made in respect of 2016. So this is a very important information for us in this question. Let me highlight it. It's very, very important in this question. And then Roman figure 2, development cost of 45 billion was capitalized during 2017. The related asset is not expected to generate any economic benefit until 2020. So development costs, let me highlight this one as well. So let me use another color. Oh, let's leave it like that. So now, the first thing we have to do here is to, of course, we've read the question, Question A is asking us to access the what accounting treatment of the change in accounting policy and state the impact on the return on capital employed. So when you look at this Roman figure one additional information, you see that they change the accounting policy. And accounting policy treatment is I think that should be IAS 8, which talks about the um, changes in accounting policy. And yeah, so this question, and there's a change. This company, there's a change in accounting policy from cost model to revaluation model for its property, which means that their their PPE, their measurements would have been done with based on the cost model method of measurement, right? So now they are changing to the valuation method, right? Which means that some of their PPE would have experienced some revaluation as a result of maybe increased in the value of the assets, or um, they purchase additional assets and stuff. So which has resulted into what is valuation surplus as recognized in what in 2017. Where is the valuation surplus? So now we have reservation surplus here. So which is this is a signal that okay, the company must have acquired an asset, right? That must have given rise to what? To a revaluation surplus. And that would have triggered the change in the accounting policy of the company. That is they are moving from the cost model method, right, to the revaluation method. So basically, that's just what we will be explaining in this A part, right? I'll show the solution as well so that we can see how it is being explained. So based on the mark attached to this question, so you are not expected to do too much of stories here, right? You're not expected to waste too much of time here because it's just carrying 3 marks for crying out loud, right? So you're not expected to do too much stories in that A part. Where the main work is in the B part of the question, and which you are going to be looking at as well. So here we are asked to what analyze the profitability, liquidity, and efficiency of Lawan PLC, which means that it's divided into 3 categories. The first one is the profitability. Second one is the liquidity, and the third one is the efficiency. So the profitability helps us to measure how well Lawani PLC is making profit, or how well they are performing in terms of profitability. That's basically what the profitability will help us to measure. And then the liquidity part helps us to know um, how liquid the company is. That is how much of assets can be easily converted that they have they can be easily converted to cash. How much of their current assets, I mean their current assets can turn back to cash for them. So they want to measure how liquid they are in terms of their current assets to their current liability, in terms of their current assets to their in terms of their quick acid test ratio. So that's what we'll be looking at under the liquidity part. And then the efficiency part of it is this will help us to measure the how efficient the company is, or are able to utilize taking profit. They can be doing well in terms of profitability. They can be doing well in terms of liquidity, and not okay in terms of efficiency, because you doing well in profitability and liquidity does not mean efficiency too is okay, because You might be making profit fine, but maybe you are underutilizing the resources that you have. Maybe the resources that you have is okay enough to make more than the profit you are making. So we'll be looking at that part, which will help us to measure how efficient my my marker. So now for profitability ratio. So this is divided into a loan that we'll analyze. We have profit margin, gross profit margin, and the formula is gross profit over sales. You can also call it turnover, anyone, or turnover times 100%. And then here also we have net profit margin. So the formula as well is just more like the same thing, just changing gross profit to net profit over turnover or your sales, anyone you want to call it. And also we have return on assets. Return on assets. Return on assets will cover your turnover, which is your return here, all over assets. So the asset here is your total asset, which is the current assets plus your non-current assets multiplied by 100%. Then we have return on equity, which is your turnover all over total equity times 100%. So like with this now, we have been able to like bring out 4 ratios to analyze under profitability alone, right? So whatever results we get will give us a clue as to how this company is performing in terms of how well is their gross profit to their turnover. That's what this one will tell us. How well is their net profit to their turnover? That's what this one will tell us. How well is the turnover realized to the total asset of the company? Imagine that, okay, a company has a total assets worth 100 billion, right? And they're only making a turnover of 2 million. That means the company is not performing well. They are not utilizing their assets to get more money. That's basically what it means. And that's the whole essence of measuring performance. Because if you are saying that you have a total asset of what 100 billion and you're only making a turnover of 2 million in a year, then something is wrong somewhere. So it means either the company is underutilizing the assets that they have and they are not making more money. So these are stuff you can use as a basis of discussion in analyzing this company, right? So that's what we'll look at here. And then we'll also look at the the um the turnover to equity ratio. That is, how well of turnover are they getting in relationship to what? To their equity. That is, the equity side is more like the owner's portion of the business. That is what the owners of the business has invested in the business in terms of um their share capital, share premium, and the likes. So how much have they invested and how much are they getting? So we want to know how well they're performing in that side too. So that's what this will help us to look at. Also, when we look at the liquidity side, I don't want to be writing out formula. I'm just trying to like explain. Formula is what I believe everybody should know now. So, but I'm just trying to like do this so that we can understand. It's not just about cramming formula in your head. It's not just about getting the answer, calculating your answer, but you need to actually understand how to interpret your answer and how to know the impact or the limitations it has on the company as it were. So now your liquidity ratio will tell us about two things majorly, which is the current ratio, which is equals to current assets divided by current liability. And then we have the acid test ratio. Some people call it quick ratio as well, or quick ratio, which is current assets minus your inventory all over CL. So there's always a ratio of 1, like ratio 2 to 1, ratio 2 to 1. That is, your current assets should be able to like double your current liabilities, right? How much of your current assets can you get from your current liabilities, right? How much of your current assets can be used to settle your current liabilities, right? That's exactly what this quick ratio is telling us. That is, your current assets, how quick can you convert it into cash to settle to meet up your what? Your short-term obligations, which is your current liabilities. Because I mean your current liabilities has to do with your short-term debt, short-term loan and stuff, your payables, your owings and stuff. So that's what's sum up to be your current liabilities. So we want to know under your liquidity ratio analysis, how much of the company's current assets can be used to settle their short-term liabilities. That's basically what the current ratio analysis is all about. Same thing too is applicable here. The only difference is that you are considering inventory. You are picking out inventory because the whole idea of picking out inventory is that okay, your inventory is still in stock. You've not, I mean, they are not yet sales, they are still in stock, you've not sold them yet. So let's remove inventory from our current assets and let's know how much of whatsoever is left can be easily converted to cash to settle the short-term obligations of the company. So, I mean, that's basically it. That's what we need to discuss under our liquidity ratio. So, like I said, it's not just about cramming formula. I just want to know the formula. Once I know the formula, I'm okay and just get the answer. And that's it. As a professional, especially in this professional stage of your ICAN exam, it's not what you did in financial reporting. If okay, in financial reporting, for example, you can just do your ratio analysis and maybe not explain, you can go scot-free. But in your professional stage of this corporate reporting, there's a need for you to also not just beyond writing the formula out, getting the answer, you also need to professionally explain the effect of your answer on the company. You need to explain whatever impact, and if possible, make recommendations to them as to areas they need to do better on to ensure that they have a good um, position on their analysis. So like this way now, like I mean, you're already solving the question, honestly, because I mean, I'm already doing what you would normally do in the examination hall. Because in the exam hall, you want to write your formula out, solve it, and so that about that. Then your efficiency. Ah, there's no more space here. Let me see if this one can just take efficiency. Efficiency ratio. Efficiency. So your efficiency ratio now um is also, like I said before, tells us about how efficient or how well a company is utilizing what they have to make more money. I mean, you can have plenty things and then you're not utilizing it enough. That's what this is trying to say. So we want to look at um receivables turnover ratio. Look at receivables turnover ratio. So yeah, the formula is your credit sales all over your average receivables, all over your average receivables times 365 days. And then we also have asset turnover ratio. Asset turnover ratio. Please don't mind my handwriting, asset turnover ratio. I just hope we are following, then we are getting it. That's the most important thing. Asset turnover ratio, that will be your net assets or your net sales, or let me say your sales all over your total assets. Or we can say your average total assets, either ways, times 365. 365 days. So we have more, but I'll just limit it to these two because of my space on my board. So um, for this receivables turnover ratio now, we want to see how efficient we are in terms of our receivables, right? So how many days will it take us for us to be able to like get back all our credit sales, right? based on the number of receivables that we have, right? That's what we are trying to look at here. So imagine that our credit state is on the high side, and then we are not recovering them back as soon as they should. Then it means something is going on in terms of our what? Our receivable collection period, right? And which is what this efficiency ratio is talking about, right? So our receivable collection period should be on the normal side so that we can be able to like um, get back whatever credit sales we are making in the business. Same thing applicable to our payable payment period. That is, how well are we able to like pay um, our suppliers, our vendors, whatever that they sell to us on credit. So that's our payable payment period, which also falls under here. And then we have the the turnover ratio that talks about the relationship between the turnover and then the average asset. So, that's it. And um, also, it's very important for you to know it's not just about formula alone. We also need to know how to identify where these variables are in the question. Imagine that well, I believe that everybody should know this at this stage. You cannot be in professional level and you don't know where your sales is in your account or you don't know where gross profit is. So, but imagine that, okay, you've crammed all the formula, you know the formula by heart, but you don't know how to identify all these variables. Then, that's already um, the other way around. So, your gross profits will always be on in your statement of profit or loss account, which this is it here. This is your gross profit, your revenue, you have it here, your trade payables, if you need to do your payable payments periods, is here. Your receivables will be under your current assets, is here. Your inventories, of course, you need your inventories. So when it comes to your total assets too is here. Your total equity is also here. This is your total equity here. Total equity. This is your total equity here, in case you need that. And what else? What other variables do I need to look out for you? Total equity. So in getting your average receivables, right? Your average receivables will be your opening inventory plus closing inventory divided by 2. So your average inventory will be equals to closing inventory plus opening inventory divided by 2. So same thing applies to receivables. Your opening receivables plus closing receivables divided by 2 will give you your average receivables. Your closing payable and opening payables divided by 2 will give you your um, average payables as well. So let me quickly show us the solution. We look at it together and then we try and explain everything together and see how that will take us. Let me share my screen on that aspect. Just a second. Um, So, based on the question, so please can we all see my screen, like the question and the solution? Can anybody confirm that, please?
Yes, we can.
Okay, good. So, based on the question, the A part of it, which is the written part, um, the solution is accounting policies are rules, principles, convention that pin the preparation of financial statements. So, like I mean, it guides us as to how we should prepare our financial statements. What are the rules and principles guiding the preparation of financial statements? So that's what accounting principles are. And then accounting principles chosen by an entity must consistently be applied, right? So you cannot say your principle of January is different from the principle you're using in March in preparing your financial statements. So it must consistently be applied. And if a change in accounting policy is as a requirement of an FRS, the policy should be applied in light of what the FRS. That is, if you want to change your accounting policy for your financial statement preparation, it must be done in line with the principles of the IFRS. So retrospective application is not applied to change in cost model to revaluation model. So in this case, the fact that this company now they are changing from the cost model to revaluation model, you will not apply it retrospectively because I mean retrospective application means that you have to go and change all the way you've treated your PPE in previous years. No, you don't need to do that in terms of this revaluation model change in cost model. So, however, when there's a change in accounting policy, such a change must be applied retrospectively. That is, going backward to reinstate the comparative figures, except where it is impracticable to do so. It is considered impracticable only when the reasonable effect has been made. Considering the financial statement of Lawani, if a retrospective application is not applied, such inconsistency will impact on the financial statement analysis, e.g., on the return of capital employed, the revaluation surplus, and the development costs capitalized will inflate capital employed for the year 2017 and consequently lead to the deterioration of ROC in 2017 compared to the prior year. So I mean that's a good um so we can see the effect of the change in the accounting policy from cost model to revaluation model. Like this they stated something here that it can the change must be effected retrospectively except in a scenario whereby it is impracticable, right? So based on the fact that for this question now, we are told to analyze the company based on their profitability, liquidity, and efficiency, which means that we are making comparison from current period with prior period, right? Since we have to deal with 2016. We are not just making comparison with 2017 figures, which is the current year alone. We need to also um, deal with 2016 figures. With making this comparison, we have to go back to the previous years. So in going back to the previous year now, the effect of these changes in accounting policy will happen because in 2016 they would have applied the cost model, while in 2017, which is the current year, they would have applied the revaluation model, and that is why the revaluation reserve is only affecting 2017 and not and have no effect in 2016 because in 2016 they've been using what cost model. So that's a good way to explain the A part of it. You don't need to do any what's it called? You don't need to do any calculation there, but let us know the impact of the change in accounting policy on the company's financial performance. And then the B part, this is where the whole um, financial ratio analysis will come in. Like you see, look at the way it is being solved here now. We have to prepare a table for it where we have our profitability ratio, we have the formula, we have the workings, we have the year, we have the workings in 2016 and the workings in 2017. So like just like I did here, they highlighted, okay, gross profit margin, which is the GPM, the net profit margin, which is the NPM, the return on equity, which is the ROE, the um the return on okay, they didn't put return on assets there, but it's also part of it. But instead of return on assets, they use the word return on capital employed. So I mean that's another extra for you. So you can have five in your own question. You can just add ROCE to it, or you add ROA to what they have done in their own solution, right? And then you do your formula in such a way that you do your workings in such a way that the examiner will be impressed as to the way you organized your solution. So that's it. So in some questions, I mean, in real life situation, right, you might not have some certain variables you need in your formula. So for example, now you might not have what's it called? You might not have I'm trying to look for an example to use. So for example, now when you look at this um ROE, right, return on equity, the formula they used here is profit after tax minus non-controlling interest minus preference dividend times 100 divided by equity. So this formula is different from the one I gave to you here, which is what turnover divided by what total equity, right? It is still the same thing, depending on the kind of variables you have in your question, that will guide you as to how your formulas will look like. If, for example, maybe there's no NCI in my question or there's no preference dividend in my question, I see no reason why for me to use this formula. I can just use turnover divided by total equity. Do you understand? So, I mean, you might not have all the variables that you need in the question, but understanding is very, very key here, and it will help you to solve your question. And then you're under your efficiency ratio. This is where you have your efficiency ratio talking about asset turnover, the inventory turnover, trade receivables, and the trade payable payment period as well. So we want to know how many times your cost of sales will be able to like be equals to your average inventory. So the same formula to just the most important thing in this financial ratio analysis performance measurement is that you need to know all of this formula. They will not give it to you in your exam. Oh. It's not like um, that they will give you tax rate in your question paper. No, this one will not be given to you in the exam. Oh. So you need to know them. You need to know all of this formula. If it's required that you cram them, please do. And once you're able to like solve it, you solve it for both years and make comparison. You can see that, for example, now the gross profit margin in 2016 is 43.2%. And then in 2017, it came down to what 41.6%. So there's a decline in the what gross profit margin here. Same thing for the return on capital employed. There's a decline from 2006 to 2017. It declined to 24.1%. So, I mean, a lot of impacts could have triggered this. For example, now for the gross profit margin, I can say that, okay, maybe the company um, cost of sales is on the high side, and that is why it fell in 2017. So when we look at, let's go to the question, what's the cost of sales? So you can see, when you look at the cost of sales for 2016, their cost of sales is what is 178,218, and the cost of sales in 2017 is 201,103, which means that this company, for them to be able to perform well in terms of their gross profit margin in 2017 compared to what they have in 2016, they need to what control their costs measure, right? So that because the way this cost of sales went up from 178 to 2000 to 201, it will definitely tell on the what on the gross profit of this 2017, and that is the impact we have seen in gross profit margin here. So I mean, these are ways you can explain your analysis. And then we have liquidity ratio, which talks about the current ratio, quick ratio, which is also the same thing as the acid test ratio, right? So want to know how well your current assets um, can settle off your short-term obligations, which is your current liabilities here. And that is basically what they've been able to um, deduce from here. So if you should look at it now, in 2017 now, under the current ratio side, right, their current assets to current liability ratio is resulting to 0.43, which means that the current assets that they have, which is 78,000 plus, is not able to set off all their short-term obligations, which is total of 182,000. Do you understand? So that means this company now, if for example now an issue came up now and they need to set off all their they need to settle all their short-term obligations, they don't have assets that can be easily converted to money to clear this off. So that's basically what you were explaining there. And yeah, that's that about that. So like I said, it's not just about calculation, cramming formula, and then putting your answer. You also need to explain. You can see the explanation in the notes now. Financial statement analysis for the year 2017, blah, 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 blah. So you can see the explanation here. So it's not just about just writing formula. You need to explain why this is this, why that is that, why there's a decline, and why there's an increase. So you can see, let me just read through this profitability explanation. These ratios measures how well the entity is performing in the area of returns. Good. I already stated that before. The higher the ratio, the better. That is, the higher your percentage of your profitability ratio, the better the company is. Right? The primary ratio here is the what ROC, which measures the overall profitability and efficiency of an entity, right? So the ROC has significantly declined from 28.7% in 2016 to 24.1% in 2017. This reduction may not be unconnected with the devaluation surplus and development costs capitalized for the year that inflated the capital employed. This slump could also be traceable to the falling profit margin. So what they're trying to say here is that they are not saying that it's connected to the fact that the company changed their accounting policy, right? They are also noting the fact that gross profit margin also declined, that could have triggered the ROC in declining as well, which can also be traceable to the fact that the company needs to control their cost measures. Maybe they don't have a good internal control system in place that is checking how they're spending this, how they're purchasing this, I mean, all of these things are what you can recommend that, okay, to control the cost control measure of the company, you need to have a good internal control system in place that can help with check and balances, and so that it's not that you just you make requests for money to purchase something and then you're just approving it straight away. It needs to go through a lot of internal control procedures so that they can be check and balances, and like somebody is vetting what we are spending or something like that. So that's what um this helps us to look into. So you can see the advice here. The management is advised to look inward, especially into the production area and the policy on overhead, with a view to cutting down unnecessary wastages. I mean, that's also what I already said. That is, they need to look into that their cost control system. That is, there are some. It's possible that they might have been spending money on something that are not relevant, or maybe they are not needed urgently. So if they have a good internal control system in place, that is, it's not that like there's a lot of procedures before a money can be spent or before anything can be approved. That will help us um, guide that will help the company adequately in cutting down unnecessary expenses. I mean, same thing. You give your explanation on the efficiency side of it, and then the liquidity side of it, and then you're done. So yeah, I think with that, I'd like to entertain questions now from the students. If you have any questions so far based on all that I have been saying, it is time to ask your question. This is a very, very important topic in corporate reporting that I tell you, you cannot escape it in the exam. It's not possible that they will not set financial ratio. It's not possible. You can't escape it. So you need to know how to analyze a financial statement, know the formulas, know how to interpret them, know how to know their impact on the business, know the effect that they have on the business. So yeah,
Somebody's using
I think
a
Can I
that's
ask a
the end of.
question?
Yes, sir. Yes, ma.
Okay. My question is on this efficiency ratio
Yes,
under inventory turnover period.
yes.
Yeah, I want to know, is it different from the inventory turnover, the one that comes with times, that when you solve it, like this one now, is it in days or in times?
Okay. So now it's actually the same thing. It just depends on how um how your formula is actually the same. If you decide that okay, you want to make yours in days or you want to make yours in times, you actually have the same, you see the same thing. The most important thing is your explanation to it, right? That's the most important thing. You might not get the same answer as to everybody in the examination, or because it's possible that you might have used a different variable for your own inventory turnover. What do I mean by this? Now, yeah, now they used cost of sales. Some people might say, okay, let me just use turnover divided by average inventory. So you might not get the same answer, right? But the it is the explanation that we want to see how well you're able to like interpret the effect of whatever result that you get on the company's performance. So whether you're multiplying by 365 days or not, that's not the what do you call, that's not the, but of course it's good to follow the general formula that is everybody knows, so that the examiner or the marker too can flow well with you. So but I would recommend that you use the one with that you multiply with numbers of days, which is 365 days.
And that's the, sorry, that's the one, because the one I solved before, which is different from the one I'm seeing here, I did
Yeah.
the average inventory as the numerator divided by
Yeah,
cost of sales.
when you look at the formula I gave you on my notes before I even opened the solution, that was what I did too.
Mm.
I said, um, oh, I didn't do that here. So I mean, you can do it either ways. You can say inventory divided by turnover, right? Or turnover, and either ways is yeah.
Okay,
So that's why
anyone
I said
can
that
go, whether the
yes,
inventory is up or the cost of sales is down. It doesn't matter.
yes. No, no, no.
Okay. Mm.
Yeah. Because if you should look at my asset turnover ratio here, I said the formula is net assets divided by average turnover. And here now they used cost of sales. So it just depends on how you're able to like understand the principle and
Yeah, exactly.
interpret them. Yeah. Any other question? I hope you are finding corporate reporting easy.
Can I talk?
Yes, yes, please.
Yes, I am, but I'm having challenges in current issues. Current issues. That's where I'm having challenge. This beyond FR and management
Before
commentary,
beyond the fact.
especially. Yeah.
Oh. So okay, if you have any issues regarding that, you can just drop on the group chat. We'll look into it, and I think we'll still be having live class session. Although that one might be general for everyone and might not be secluded for as this one is. So we can also look into it at the live class session as well. So the most
Okay.
important thing is the know the key question, which is group accounts, the financial ratio that we treated today, and I mean know your IASs, IAS 7, IAS 16, IAS 2 inventory and stuff. So that I mean the key EPS, um, EPS, which other one? Income tax, yeah, income tax. If you're very good in tax, income tax should not be an issue for you. And I mean, you're good to go. Thank you very much, everyone.
IS7 is it cash flow, right?
Cash flow, yes, yes, cash flow.
Okay.
Yeah.
The EPS, that is earning per share.
Yes, any special. Yeah.
Is it, does it fall under ratio?
Yes, it's
I've
under
not looked
ratio
at
as
that.
well. It's under ratio as well. It's under ratio as well.
Okay. Okay.
Jola Ade Lore, do you have any question?
No, I don't.
Okay, thank you. Western Lean Age, any question?
No question.
Okay, thank you. I think we are good. Um, over to the admin. I think I'm done with my session.
Okay, thank you very much, lecturer. I just want to wish
Yes.
everybody the very best in your exam. So, good night, everyone.
Good night.